Welcome to In Depth for a closer look at what is making mining headlines in the Americas. The merger and acquisition machine kicked into force again in Canada at the end of August, with two interesting deals being announced in as many business days. Mining Week's deputy editor for North America, Matthew Hill, who is based in Toronto, joins me to shed insight on some of these issues. Welcome to the show, Matthew.
Hello, Martin.
Matthew, there have been two fairly sizable deals unveiled in the Canadian mining scene over the past few days, but not everyone is necessarily happy about them. Why is that the case?
Yeah, well, I suppose that they sell the more, you can't always please everyone. But in the case of the first deal that got announced, Cameco's $520 million unfriendly play for Hathor, Hathor hasn't formally rejected it as I speak, but it's widely expected by the market that they will. Basically what happened there is Hathor owns a pretty juicy uranium deposit near Cameco's Rabbit Lake mill in Saskatchewan, where they've got a bit of spare capacity and they're hoping to fill it with ore coming out of Hathor's Rough Rider deposit. And Hathor basically got punished, its share price has been punished by the market since the Japanese nuclear disaster in March. Pretty much all of the uranium juniors have. And Cameco is taking advantage of that, looking to use their pretty substantial cash pile to make a hostile bid for Hathor. The other key thing there is that Hathor aims to publish its first preliminary economic assessment into the Rough Rider deposit by mid-September, and they're going to be hoping that proves that the company is worth quite a bit more than what Cameco is offering for it. That deal was announced on the Friday, and then on the Monday morning, the North American market woke up to the news that Orica Gold was making a $1.4 billion all-share play for Northgate Minerals. Now that deal was friendly. Northgate and Orica saw eye to eye on valuations there, but Northgate had previously agreed to tie up with Joe Conway's Primero Mining, and now he's been left standing at the altar, probably feeling a bit disappointed.
Matthew, I see that Hathor was rather quick to label the Cameco deal as opportunistic. How is the bid likely to play out?
Yes, and they're probably right to call it opportunistic. At the end of the day, business is a business, and there's nothing wrong with trying to be opportunistic and squeeze out a bit of extra value for your shareholders. There have been some names thrown about as potential counterbidders to Cameco, France's Areva being one of them. They vie with Cameco to be the world's biggest uranium producer, and in fact they own the McLean Lake operation, which is actually a few kilometers closer to Hathor's Rough Rider deposit than what Cameco's Rabbit Lake mill is. The other possible outcome is that Cameco is forced to make a higher bid for Hathor if an insufficient amount of shareholders tender their shares to the offer. I suppose it's also possible that Areva and Cameco could both join up for a combined bid for Hathor, seeing as though they could both stand to benefit from receiving ore from the Rough Rider deposit sometime in the future. Cameco does have plenty of cash to up a bid, and depending on what the preliminary economic assessment on Rough Rider says come in September, there's, I would say, a pretty good chance that they do have to offer more to Hathor's shareholders.
Matthew, as you mentioned, Primero is probably not too happy that their deal with Northgate has fallen through. Is their CEO, Joseph Conway, going to be looking at other tie-ups anytime soon?
Yeah, definitely. Some of the analysts that I've spoken to said that he'll probably be looking to seal a new deal sooner rather than later. The issue there is that Primero owns the San Dimas mine in Mexico, which produces both silver and gold. and they've got a pretty significant problem where they've got to deal with a company where they sell most of the silver from the operation at $4 an ounce to this company, while they're paying the Mexican authorities tax as if they were selling it for the spot price, which currently stands at around $40 an ounce. So that's not too good a deal for them. They're looking to change that. But Joe Conway says that might take 12 to 18 months to get a tax ruling on the matter. And I think he would be keen, certainly he would be keen to seal a new merger or acquisition before then. The problem is that this tax issue has been a drag on Primero's share price. He's looking to do an all-share deal, which makes it difficult. Then the other thing is that he's indicated that Primero is only really interested in precious metal companies, gold and silver companies that have projects or production in the Americas, and also ones that are also unloved by the market, that have seen their share price languishing over the past few months and perhaps are undervalued. Now, if you take those two measures, it does leave you with quite a short list of possible targets. Names that have been mentioned include Lakeshore Gold, which has had production problems up at its operations in northern Ontario, and the market has punished it for that, which means it might make a valuable target for Primero. Then the other company that has come up is Horizon, which owns a gold mine in Quebec and also a development project in Quebec, and say that both those companies would fit pretty snugly with Primero.
Thank you, Matthew. Well, that's the show for today. Join us again next week for more news and insight on mining in the Americas. I'm Martin Joaquino for Creamer Media in Johannesburg.